I am here with Carolyn from North American Title. She's like my title gal. And I wanted to have her explain what supplemental taxes are because they're super confusing and they always are, they're just confusing. So I'm hoping you can explain to us what supplemental taxes are. So when you buy a house, you're gonna get a supplemental tax bill, probably. Right?
Like probably within 3 to 6 months after escrow is closed. It'll be billable in 2 installments. Depending on the tax season, the time of year, between January and May, you could get 2 bills, each bill having 2 installments. If it's from June to December, you'll get 1 supplemental tax bill paid in 2 installments. And what they do is they take the current market value and put into their formula the supplemental taxes are issued based on a change of ownership or new construction, and they take the difference between the new sale and current, and the difference is what generates the supplemental tax bill.
Okay, so if you have an escrow account that you're setting up when you purchase that's going to pay your taxes and your insurance, is the supplemental bill part of that?
It is not.
Okay.
Your impounds are created and calculated at the time your loan is set up. Mm-hmm. So they do not take into consideration supplemental taxes because supplemental taxes are a one-time billing.
Okay. So that's good to know, one-time billing.
One-time billing for each change of ownership or an event that causes supplemental taxes. So again, that was a change of ownership or new construction. Mm-hmm. So the lender will not take responsibility for paying those. That will be the homeowner's responsibility.
Right, okay. So if you're adding on to your house, your property will get reassessed because it's worth more. And then there's supplementals on that.
Yes,
also?
if it's significant to change the market value. Mm-hmm. So
adding bedrooms.
Adding an addition, remodeling your master bathroom doesn't count. Oh, okay. So it would have to change the market value of the property.
Right. But also let me add, if you get something in the mail, it'll say supplemental tax bill. You have to pay that. That's not something that the lender is going to pay. So I wanted to just make that clear, that when you get a supplemental tax bill, you have to pay that separately. But is there a way to estimate what that will even be?
I personally don't like to guess what that is because it's not a predetermined formula per se. If you took a property sold, current market value is $500,000 and it sold for $650,000, so the difference being $150,000. If you took 1.25% of that $150,000, you might come up with a good guesstimate.
Right. But we don't know when the assessor will get there because that's all part of it, right?
Right. It's all part of the assessor.
So it's the difference in time between when the assessor gets there and the purchase of the home? How long do they have to get there?
They don't have a time frame.
Oh, they don't?
No.
Oh.
Not
so
like
you could
we
be a couple
have.
years into it and then...
I don't think it'll be a couple of years. It's generally within the same year. Mm-hmm. Or within 3 months. Okay. Because they want their money. When we had the market crash and property values went down, market value went down, sometimes there would be a supplemental tax bill in a negative amount.
Oh, so they get a refund.
They would get a refund. Oh. Or it would say, we'll credit you on the next bill.
Right.
Nothing due at this time.
Right.
So we're really at the mercy of our county tax collectors. But if I had to, help someone try and, determine how much money they had to put away each month to be prepared for that supplemental tax, that's the calculation, 1.25% of the difference.
Okay. And when they set up the loan in the first place, though, they base it off of the purchase price.
Yes.
Right? So your escrow account is going to have that money in it, right?
Yes.
So something that I have noticed is that when yearly the lender will do like an escrow analysis, and you'll get a refund if there's too much money in there, and it should in theory be a very similar amount, right?
Yes.
So I mean, that's in theory a little bit. But
well, again, the lenders are trying to guess.
Right, the lender is calculating their impound account is correct, but when they pay that payment, when it's due, it's based off the old tax bill. So there's that extra in the account. So if you get a refund on your escrow analysis, put that in the bank to pay your supplemental tax bill when it comes due.
Yes, that's a good idea. That's a really good idea. Personally, I have impounds, and my lender did an escrow analysis, and it was determined that my taxes for 2019-20 were going to be increased, when in fact they went down. But my impound account still went up to calculate and be able to collect the higher tax payment. So I think I'm just going to leave it alone, because eventually it'll work out and it will be up, and then I won't have to, I'll be already used to making that higher mortgage payment.
Right. Yeah. So my overall point in this little video explanation is that when you buy a house, you're going to get a supplemental tax bill. And if you set up an escrow account that'll pay your taxes and insurance each month, the supplemental is not going to be a part of it. So if you get that bill, you still need to pay it. Do not think that your lender is going to pay it. So anyways, thank you so much
You're
for
welcome.
all of the advice. And she's awesome. If you are a realtor and you need some help, Carolyn is awesome. Hey guys, thanks for watching my videos. If you need help with your purchase, refinance, cash out, reverse mortgage, give me a call, shoot me a text, send me an email. I'm here for you. I am licensed in California and Utah, so I hope to talk to you soon.